Hello, this is Craig Larson with Larson Financial Advisors and the Market Minute for September 16th, 2013. So yesterday was the 5-year anniversary of the Lehman Brothers collapse back in 2008, which accelerated the downward spiral and really put us in the crisis part of that bear market back then. And I know some people from talking with them are very paranoid about when the next market collapse is going to occur. And of course, none of us know with any exactness when that's going to happen. But I thought I would go back and reflect on some technical indicators that came up before the Lehman collapse. So early in 2008, fund scores on our fund ranking system started really deteriorating, and technical indicators in general on the U.S. stock market deteriorated. So they were sending up a lot of red flags, a lot of caution signals. And by June or July of 2008, there were just some massively significant red flags about the U.S. stock market. So what generally happens, not all the time, but generally in a real bear market, negative stock market, you're going to get some warning signs, and those tops are usually fairly quiet. And for those of us that will be watching, we hope to be able to give you some cautionary signals before the next real bear market sets in. Now, right now, we're not seeing anything of the sort on trend indicators. Fund scores on our scoring system for U.S. stocks are still very high, very robust, and I think the long-term trend is very much in place. Now, that being said, we haven't had any kind of a meaningful correction in stocks, so I think there's some steam built up in the stock market that needs to be released. That may mean that we get a 5 or a 10% correction, and that would, in my mind, be the first good opportunity to look at plowing some money from the sidelines into the market if you have some. So secondly, for international rankings, international stocks have been in the number 2 position behind U.S. stocks for most of the year on our ranking system, but threw off some red flags and some signals because emerging markets were very weak. They appear to be trying to firm up here, and thus international looks like it's presenting some opportunities. Still need to be careful though. We're seeing some areas and some certain types of funds not doing well, others are doing well. So you need to be careful about your shopping list there, but it does appear that that's improving a bit. Thirdly, as far as gold, got down as low as $11.90 an ounce, bounced back considerably and appears to be rolling over and going back down. And the fund scores on the ETFs like GLD are very tepid. So I think gold probably still is not a very good opportunity yet and may have some more downside work to do on the gold price. And the miners, as far as gold, they look like they were having a big rally too and have just gotten slaughtered in the last couple of weeks. So we'll keep you posted there at some point in the future. Who knows when? That'll be a good investment opportunity to consider. Finally, just wanted to end on a high note because sometimes we hear data about how bad the U.S. debt is and the unfunded liabilities of Medicare and Medicaid and Social Security. And I did hear just a fantastic piece of good news the other day when I was reading about energy. And the U.S. now is the world's second largest producer measured by total oil output. We're second only to Saudi Arabia now. And in the last 5 years alone, we have cut our energy trade deficit in half. Just 5 years, cut it in half. So absolutely tremendous things happening in the energy world. As an investor, you want to tune into some potential opportunities there because I think this will continue to get better and better for the U.S. and can certainly, at least potentially, provide the growth we need to grow our way out of some of these debts that we've accumulated. So we'll keep an eye out on that for you. Please call or email me if you have questions or you want assistance on something, and I will look forward to talking with you again soon.